This is a paid advertisement on behalf of Tribe Property Technologies. What's going on, guys? This is Aaron from Departures Capital, and we're here with Joseph Nakla, CEO of Tribe. Pleasure to have you back on, Joseph. We've had you on many times. How's it going?
I'm doing really well. Great to be with you again, Aaron.
Yeah, so let's talk first about financial momentum. So Tribe recently posted strong Q4 and Q1 results with two consecutive quarters of positive adjusted EBITDA. Can you walk us through the key drivers behind that financial performance and what it means for the company going forward?
Yeah, absolutely. For those that don't know much about us, we are a company that started as a pure tech company that's set out to disrupt the way property management, traditional property management, is being delivered to condo communities and rental communities. We're unique in that we are the only company in Canada now officially that is actually doing both institutional rental management and condo management across on a national footprint across the country from coast to coast. That tremendous growth we've experienced can be highlighted perhaps by an easy metric to understand. In 2018, January 2018, we had no assets under management, and as of today, we were north of $42 billion of assets under management. Not to impress, just to explain the magnitude of the growth we've experienced, and these assets that we manage, we charge fees for, and we give them all of our software and technology to help improve the efficiency and operation of the building. And in return, we obviously realize the revenue. And then because of the amount of data we have, we can actually put products and services into these homes, into these buildings, and so on and so forth. So to answer your question specifically, absolutely, we went and made big investments in creating a national footprint. This meant that we acquired assets, we built compliance across the whole country, we got our technology to operate properly across the national footprint. And in return, as we built that investment, we had to backfill in our growth and our sales into our size, and that coincided with Q4 last year. This is the point where, obviously, because of the infrastructure we invested in, started to yield us results in terms of revenue. And now we're EBITDA positive due to the fact that we're backfilling into our size. And you can see that with the growth of our revenue year over year.
Awesome. So let's talk about your strengthened balance sheet. You recently raised 5.7 million, which has been used in part to reduce debt and also position Tribe for future growth. Can you talk about how this improved financial flexibility impacts your strategic roadmap?
Yeah, absolutely. I mean, we're very proud of the fact that we were able to raise capital in a time when nobody's raising capital. And that just kind of spoke to how the street understands our model and the fact that we've been executing. It was mostly institutional investors again coming into our company, understanding that the future is looking really positive. The strength of the balance sheet essentially allows us to improve our essentially trade some of the slightly higher expense debt, and also allows us to continue to be very aggressive in M&A. For those that don't know, we've made 15 acquisitions to date, and now we've been really focused on very, very profitable, accretive transactions that really add to the bottom line. And the last couple of transactions are a great example of that. And we continue to grow our footprint, not only in acquiring property management companies, but also acquiring products and services that we can sell into the buildings that we operate.
So now let's talk capital allocation and M&A strategy. So M&A has been a key pillar of Tribe's growth. Could you share your capital allocation strategy going forward and how recent acquisitions like Ace Agency fit into the bigger picture?
Yeah, so very specifically for those that don't know, Ace Agency is a company that specializes in what we call single unit rental. So think of condos like the ones behind me or the ones that you live in. And there's many of those units, even though they are in a stratified or a condo corporation, but a lot of those units actually are available to be rented out on behalf of the owner. So what Ace does is it's one of the larger Lower Mainland. This is us here. Lingo from Vancouver, in the Lower Mainland, one of the largest single unit rental management company. And it's an area that we dabbled in, but we didn't have big presence. For those that hear about us, very active in the rental space. We're actually active in institutional rental. Think of a pension fund, think of a REIT, owning a full building, either building it from scratch or acquiring it, and they come to us and we manage the whole asset, the whole building, including all the affairs of the building with our tech and stack and services. But in the case of Ace, they actually manage one or two or three units in a building. And then they had up almost 1,000 units under management. And the reason we really like that space is because we're seeing more and more, especially with the real estate activities around us, where people actually that own these units want to rent them out. And they're looking for a service provider to deliver that because it's not a simple rental market anymore. So, because we manage 55 plus thousand units across the country, we have an amazing opportunity now with the ACE expertise to say to you as a condo owner, we know you've been renting it out yourself. It's becoming more difficult for you to rent it out. Would you like a systematic, more visibility and quite frankly, a lot less risk by allowing one of our divisions to rent that up for you? So that's one of the main reasons why we did that. The other trend we're seeing, which is very, very present, especially if you're paying attention to the news, is a lot of developers building brand new buildings, those big towers that are being completed, they're not selling. So some of these units are not moving. So what the developer is designing their financial strategy moving forward is actually to rent out the number of those units that are not being and they're not available to sell or not moving, essentially to be sold. So we're actually coming in with a product that allows a developer to say, okay, we sold 70% of the building, we're left with 30%. Hey, Tribe, due to your acquisition of Ace with the expertise, can you rent those out for us? And that's, again, it's that single unit management model. It's more profitable, better gross margin. So we're quite pleased with that acquisition.
Totally makes sense. It's part of the business. So speaking of Ace Agency, what attracted you to that business in particular, and what synergies do you expect to realize now that it's part of Tribe's ecosystem?
I'll be honest and direct and say the entrepreneur, a young, very, very committed to the cause, energetic, and we thought he'd be great addition to our executive team. So the operator, the founder and the operator were essential in the decision making that we've made. And as you may know, we did the deal with all stock. And believe me when I tell you, we don't usually do that simply because, we think our company is incredibly undervalued. But he came in and he did not want any cash. He took the whole transaction was done in stock. That showed massive commitment on his behalf and our behalf. But we really like the product and the way they position themselves in the market. And like I said, we think we can triple, quadruple the business of that company in a pretty significant time here.
So looking ahead with a strengthened balance sheet, a track record of M&A, and improving financials, what should shareholders be looking forward to in the second half of 2025 and beyond?
Well, we're going to be very active in M&A as well. I can't promise anything, but we're looking to a lot of interesting opportunities. You're going to see us continue to drive, more energy towards profitability. A lot of the acquisitions we've made, we're integrating them. It costs a little bit of money to integrate, but once you integrate them, you start realizing the value of the efficiency. So you see us more active on that. So I think we told the street we've turned the corner on the EBITDA side of it. Obviously, the cash position that we have allows us to, like I said, maybe reduce some of the interest payments that we were making previously, and also be very active on the M&A side. So we really feel like we've turned a big corner in Q4 last year, and we'll continue to be on that right direction.
Well, congratulations on everything you've accomplished so far. Hopefully, the market realizes that soon. I guess that's next, hopefully, but we'll have to have you back on, Joseph, for more. It's always a pleasure.
Absolutely. We feel incredibly undervalued, and it's highlighted by the number of us insiders that have purchased the stock in the last couple of rounds, and the street will eventually come around.